Hey Hodlers, did you miss me? I know you probably went a little crazy this week with Bitcoin's price jump. To sell or not to sell? Everyone has their own theories, which I'll get into soon, but my personal opinion is that it's an unexplainable gift from the gods, and let's just not look in too closely, lest it turns on us. The one thing that we can agree on is that Elon Musk was seemingly inspired by the crypto fervor and hopped on Twitter this week to proclaim his love for Dogecoin, but this was close enough to April Fools that I slightly question his true dedication. Ladies and gentlemen, I'm back, I'm Molly Jane, and this is your weekly Hodlers Digest. Let's take a look at the latest market updates. This week following alt season, where many altcoins were outperforming BTC, Bitcoin surged 15% in an hour, breaking through the 4.2K resistance and eventually reaching a high of $5,000. After exile and a long crypto winter, Bitcoin is finally back in the driving seat. There are many theories ranging in various degrees of credibility. First up is longtime Bitcoin bull Tony Vase. He thinks that the recent surge had no specific trigger. In an interview with Cointelegraph earlier in the week, he said that he always expected Bitcoin to hit $5,000 once it had passed $4,200.
Shorts got liquidated, there were short squeezes, more people jumped onto the hype, and a lot of news media always look for a trigger to cause big drops and big rises, and I would say more than half the time, they're just trying to match news to something that it doesn't necessarily needed news to happen.
Some of the more interesting theories include Brexit, algo trading, and even an April Fool's joke. The ongoing Brexit debacle has led to a lot of panic and uncertainty in the UK, their version of FUD. A recent study found that £66 billion have been wiped off the market since last June, so there is speculation that investors might be converting their pounds into Bitcoin ahead of Britain leaving the EU, although when that actually happens is anyone's guess. A more mysterious theory has to do with algo trading or algorithmic trading. According to Bloomberg, there were reports of a $100 million Bitcoin order that triggered computer mechanisms. The order, allegedly spread around major exchanges, Coinbase, Kraken, and Bitstamp, led to the price surge. The real trigger, of course, was the SEC approving a Bitcoin ETF. That's the real reason. But apart from the fact that this never happened, on April Fools, the publication Finance Magnates ran with the headline, "SEC drops the bomb, approves Bitcoin ETF." This is perhaps one of the less credible catalysts for the surge. We spoke to Rand Neuner and his thoughts about what's happening.
I actually published a tweet a few days ago where I said there are over 1 million people on crypto Twitter, and not a single one of them can tell us why the market went up. And I've heard all of the conspiracy theories. I've heard about the algo trading. I've heard about the mysterious $100 million order. I've heard about the Russians loading up on cryptocurrencies. I've heard about the fact that it may be related to the SEC, and of course that it may be related to the article by Finance Magnates around the April Fool joke that they did about the SEC approving the ETFs. None of those make sense. And I think essentially what we should accept is that the reason why the market went up is because crypto as an asset class has been oversold for a long period of time. Now, as to why it went up so fast, so quickly, I'm not sure that anybody has been able to unravel the puzzle. But what we can say is we know that the market has been depressed because if you look at the fundamentals of the market, which is the adoption of the technologies, the number of apps being built on blockchains, the number of users that are growing, there has been much more progress than the market has given us credit for. And I think it was the case of the market playing catch-up.
The U.S. Securities and Exchange Commission issued the long-awaited framework providing guidelines for startups planning to issue tokens in compliance with U.S. federal law. While not legally binding, the framework is meant to be an analytical tool to help market participants assess whether the federal security laws apply to the offer, sale, or resale of a particular digital asset. The criteria applied reflect those of a Howey test, the standard methodology adopted in the US to define whether a transaction can be defined as an investment contract and therefore a security. The question of whether a token is a security or not has major implications for the issuer. In case the token falls under the definition of a security, then the company that issues it needs to undergo a time-consuming and expensive regulatory process. According to the definition provided on the framework, an investment contract exists when there is the investment of money in a common enterprise with a reasonable expectation of profits to be derived from the efforts of others. Despite the fact that many welcome the framework as a significant step toward crypto regulation, many observers criticize the document in being far too vague in many aspects. For instance, the concept of active participant, a key figure contributing to define a token as a security, is very broadly defined in the framework as someone whose managerial role can have an impact on the success of the digital asset. Among other questions which remain unanswered include in what case a token stops being considered a security and how the regulations apply to tokens which are issued outside of the US. We talked to Drew Hinks, Attorney and General Counsel for investment bank Athena Blockchain, and Aaron Crown, Principal Attorney at Crown Law, and asked them to discuss the new framework.
So in that respect, it's not quite as helpful as a full-fledged law passed by the legislature might have been, or even rulemaking or even formal guidance. So putting forth more detailed questions and considerations is helpful for people who want to launch systems and helpful for their attorneys because it clarifies and gives more granular information to allow them to analyze these systems to determine whether they think it makes sense to offer them as securities or not, determine whether it makes sense to seek no action letters or not. Overall, I believe that this is a positive development for the industry in the United States.
It's positive from the perspective of the public and sort of putting together the communications from the SEC that some of which they've made, but it's been sort of scattered in various speeches and other statements. And some of it is more new. It looks kind of like a series of potential red flags, and the temptation is to try to completely avoid any red flag, right? It's a concern at least. So in that sense, I'm worried about a chilling effect for clients, and I have to go to clients and say, well, there's A, B, and C are red flags, and the SEC is either listing them or emphasizing them here in these releases they've made. So we have to think twice about doing some of these things. And so in that sense, while the SEC gave something, it also, I think, effectively took something away in terms of a potential breathing room for ICOs as we have known them. So some of the top red flags that have that sort of nature that come out of this release, and the SEC repeatedly emphasized these, were the aspect of having kind of a third-party market or market making for a token. So something that's off your platform. And of course, the classical example is crypto exchanges, right? But it could be other things as well. Engaging with a market maker. For instance, they mentioned the use of token sale proceeds for development, or really any sort of general purposes, as an area of concern. So that, obviously is a huge motivator for ICOs generally, is to raise money for development. So if that's a red flag, obviously that is, that's throwing some serious cold water on the sector.
It again focuses on, at a certain point, whether an instrument that was issued as a security is no longer appropriately thought of as a security because there's no longer reliance on the issuer or some central actor to create value or to create the return. And while the elaboration on the factors, I think, was really helpful, it doesn't give us what we need as practitioners to understand what to do with that information. I think if people using tokens to raise funds had behaved themselves over the last 3 years, you may find a more cooperative regulator. But what did we do when we found that it was easy to sell tokens to each other? We committed rampant fraud. We ripped each other off left and right. We manipulated markets, and we did all of the things that regulation exists to prevent.
That's just their posture, and that's not going to change anytime soon. The only thing that would change that, I think, is if there was some new legislation that, say, created the ability to have a regulatory sandbox in the U.S., which other countries have done, as you know, and it's certainly a great facility, but we don't have the legal provisions in the U.S. for it.
Fintech giant PayPal has made its very first investment in a blockchain technology company, joining a Series A funding round into privacy-focused startup Cambridge Blockchain. The startup provides blockchain-based solutions allowing financial institutions to give customers total control over their own data. Neither PayPal nor Cambridge Blockchain have disclosed the size of the investment, but according to data published by the SEC, the amount should be less than $3.5 million. Considering the multi-billion-dollar size of a company such as PayPal, the investment is quite modest, but it is still a sign that PayPal is continuing its exploration of blockchain technology, which might have massive consequences in terms of spreading adoption. As PayPal co-founder Luke Nosek pointed out at the World Economic Forum this year, at its inception, PayPal was inspired by the same ideas of decentralization as the foundation of blockchain.
We don't know this, but the mission of PayPal was to create a global currency that was independent of interference by these corrupt cartels of banks and governments that were just debasing their currencies.
Eventually, he explained, PayPal could not fully realize that vision due to pressure from financial institutions. That did not prevent the company from taking some steps into the crypto space, for instance by partnering with US crypto exchange Coinbase, which implemented PayPal withdrawals for fiat currency. By partnering with Cambridge Blockchain, it seems PayPal understood the growing demand of personal data privacy. Currently, around tens of billions of dollars worth of data are sold annually, with the data owners earning zero profit. By leveraging blockchain technology, Cambridge Blockchain aims to give back to individuals the ownership of their digital identities, preventing centralized data owners such as Facebook and Google from making a profit out of them. We talked to Matthew Commons, CEO at Cambridge Blockchain, and asked him to give us more insight into their partnership with PayPal.
There are really business problems where you don't necessarily want one entity to see all the data and control all the data. So we think that identity itself is really a natural application area for blockchain. And when we look at the early deployments of our software, it's typically been in the financial institution space and involving the sharing of know your customer data and onboarding data. So it's a big pain point. Know your customer checks are typically fairly expensive, fairly time consuming, and not the best customer experience. For Cambridge Blockchain, we found the best early traction in Europe. Mainly because of things like the GDPR and the strong data privacy rules. It just provides more challenges for managing sensitive data in centralized databases. So when we look at the PayPal use cases, a lot of them are similar in nature. So we're exploring things, many of them having to do with know your customer checks, sharing customer data both within the PayPal ecosystem as well as potentially with external parties, and making an onboarding process that is faster, lower cost, and a better customer experience.
So Matthew, how is your product going to benefit like a big company such as PayPal?
I think PayPal is absolutely a supporter of strong data privacy. And I think even more so than that, I think the market is really starting to demand that much more so than in the past. I think Europe has always been a leader in data privacy, and I think you see that with things like GDPR. But some recent events, I mean, whether it's the hack of Equifax, whether it's the Facebook Cambridge Analytica scandal, these have been real perception-changing events and have driven an increasing awareness of data privacy on a global basis, especially in the United States, where you have a new data privacy law that was recently passed in California, and there's actually discussion of a federal data privacy law as well. So I think the world is changing. I think people are starting to be more concerned about how their personal data is managed. And I think they're starting to demand more control over that. So I think that broader context is definitely shaping this investment as well.
So what do you think about PayPal's stance toward data privacy issues?
So a lot of it is reinvesting in R&D and also working on scaling the technology to much larger numbers of users. We're starting our deployment.
How do you plan to use the funds that you just raised?
In Luxembourg, which will be with about 600,000 end users, and that's going very well.
Coinbase has expanded into cross-border payments with XRP and USDT. Anyone with a Coinbase account can send and receive funds internationally, convert them into local currency, all without having to pay a fee, apart from the on-chain fees, of course, for transactions outside of Coinbase. Last month, Ripple began a big push for cross-border payments and remittances by partnering with India's federal bank, who now use the Ripple network for cross-border remittances. They also launched 2 remittance platforms in the UAE for making payments to India. While there are some clear use cases for the tech, Coinbase's decision to expand into this area was not welcomed by everyone. CEO Brian Armstrong opted to do an AMA on YouTube. Many of the questions were pretty softball.
We love Bitcoin. Hopefully anybody who comes to meet me in person, they'll be able to be friends with us.
But some were more critical. For example, one participant took issue with Coinbase's assertion that Ripple and USDT was optimized for cross-border transmissions compared to BTC, saying, "The rationale of faster processing is BS, given Bitcoin has many more fiat off-ramps for those internationally." Brian Armstrong responded,
And you can definitely send BTC off platform as well and use it for remittance. I think you're referring to, there was a landing page that we put out that was sort of emphasizing some of the use cases around it. Don't read too much into that. Like you can do remittance with crypto on Coinbase in XRP, BTC, USD coin, all of the above.
Eventually, Armstrong agreed with the participant that Bitcoin does have more fiat off-ramps. Unsurprisingly, one topic that didn't come up was the whole neutrino affair. Coinbase recently acquired Neutrino, whose leadership were members of Hacking Team, a tech company that worked with repressive regimes to monitor political activists and journalists. Despite the fact that it wasn't mentioned, the scandal still cast a shadow. When he spoke about the most ambitious thing he wanted to do in the next 5 years, he mentioned Venezuela, saying,
50% or more of all transactions in the economy are happening in crypto. Like that would be amazing. Maybe, honestly, like overthrow some corrupt dictators in the world. That would be awesome.
Coinbase cannot be held responsible for the past actions of Hacking Team, but it certainly doesn't look good when the head of an American company casually talks about overthrowing foreign leaders, no matter how corrupt. This episode is sponsored by YouHodler. Is your regular wallet empty but your crypto wallet full? If you are a hodler with no cash, you can now borrow fiat hassle-free. YouHodler provides crypto-backed loans, which means you can borrow up to $30,000 in cash instantly and use your crypto assets as collateral. YouHodler accepts all major credit cards and cryptos. Automated KYC and AML checks mean the whole process takes a matter of seconds. With YouHodler, you can get USD, euros, or even stablecoins like USDT, if you are a true hodler. You can also link up your personal debit or credit cards for quick loan withdrawals. Once you repay the loan, you get your crypto collateral back even if Bitcoin has gone to the moon. Also, YouHodler now lets you buy crypto with fiat. Check out YouHodler. The link is in the description below. There were a million theories for the sudden price surge this week. In the comments below, give us your reason. Ridiculous answers only. And as always, remember to like, subscribe, and hodl. Cointelegraph. Like, subscribe, and hodl.